Take in hundreds of billions of dollars in tariffs, and we're going to make our country so strong and so rich, it will never be so rich. Tariffs, it's a beautiful word, isn't it?
So tariffs are on, they're delayed, they're off. Who knows if they'll come back or when or for how long?
Point is, these tariffs are necessary. I've been talking to President Trump, and I can speak exactly to his intentions on tariffs. I mean, come on. Y'all heard Donald Trump. He said during the campaign, we're doing this. It's an economic street fight. So you better get on board because the pain is worth it to bring back manufacturing, even if it leads to higher prices. We are not backing down.
Okay, but the American people don't like higher prices.
Then forget the whole thing. Tariffs off. All right? I don't even know who suggested it.
Trump did. He said they're necessary to bring back America's economy.
And they are, which is why they're back on.
Wait, so we are doing tariffs?
Damn right we are. I ain't scared of shit.
Not even more expensive housing?
Tariffs are off.
But that will increase the trade deficit.
On again.
Well, what about the price of breakfast?
Off in the morning, on at night.
The U.S. just lost its second-largest LNG market to China. But that's only the beginning. While Washington tightens trade through tariffs, Beijing is quietly redrawing the global energy map. From Europe to Asia, from liquefied gas to crude oil, and even the financial system itself, a new game is unfolding. And in this game, the winner doesn't strike directly but simply withdraws at the right moment. What's really happening behind these multi-billion-dollar deals? And who is truly steering the post-USD world order? China's shift in LNG imports. In March 2025, China, the world's largest liquefied natural gas (LNG) importer, made a dramatic and telling move by cutting all LNG imports from the United States. While on the surface this may appear to be a straightforward retaliation against the U.S. quote, as 10% tariff on Chinese goods imposed just a month earlier, the deeper layers of this decision reveal a complex, calculated shift in global energy alignment. With roughly $2.4 billion in annual LNG trade instantly frozen, this wasn't just a trade decision, it was a geopolitical signal. Rather than scramble for short-term solutions, China smoothly redirected its LNG purchases to Australia. And this wasn't merely about proximity or price, though those were clear advantages, with Australian LNG being up to 20% cheaper and saving around 10 days in shipping time. This was about control. By deepening ties with a geographically closer and resource-rich ally, China is reinforcing its long-term strategy. Reduce dependency on Western energy markets, especially those susceptible to abrupt policy shifts. From a broader perspective, this shift also reveals an emerging global pattern. We're entering an era where energy trade is not solely dictated by economics, but increasingly by geopolitics, logistics, and strategic alliances. China's pivot reflects not just energy pragmatism but a growing mistrust in the predictability of U.S. policy, especially under protectionist agendas. The trade war may have begun with steel and semiconductors, but now it's reshaping entire energy corridors. What's especially intriguing is how Australia, a traditional U.S. ally, now finds itself benefiting from the fallout of U.S. trade aggression. This underscores a sobering truth in international commerce. Alliances are not always permanent. They are pragmatic. In an age of multipolar influence, loyalty often follows opportunity. Implications for the U.S. LNG sector. The sudden halt of LNG exports to China has thrown a wrench into the gears of the U.S. energy industry. With China previously accounting for a sizable portion of American LNG sales, making it the second-largest buyer globally, the abrupt disappearance of this lucrative market, valued at $2.4 billion annually, reveals how vulnerable even the strongest energy sectors can be in an increasingly politicized global economy. This isn't just about market numbers, it's about strategic missteps. The U.S. had positioned itself as a dominant LNG exporter, banking on the idea that global demand would remain steady and diversified. But when geopolitics override market logic, that assumption collapses. Now, U.S. LNG terminals are facing an oversupply crisis. Contracts are being terminated or renegotiated under unfavorable terms. Storage costs are ballooning, and the volatility in shipping routes is forcing companies to reroute tankers mid-voyage, often at a loss. Worse still, finding alternative markets isn't as easy as flipping a switch. European countries, once prime candidates, have increasingly diversified their energy portfolios, turning to renewables and forging deeper ties with suppliers like Qatar, Norway, and now China. Meanwhile, emerging Asian markets such as India, Vietnam, and the Philippines present logistical and infrastructural challenges for high-volume, long-distance LNG delivery. The deeper concern is the fragility this exposes in the U.S. energy export model. America's LNG boom was built rapidly on the shale revolution, but that very speed now leaves it exposed. A system built on aggressive expansion without geopolitical foresight becomes brittle in the face of shifting alliances. The takeaway? Energy dominance without diplomatic strategy is unsustainable. As the U.S. looks to rebuild lost ground, the question becomes not just where can we sell, but who can we rely on in a world where politics trumps profit? Canada's oil export diversification. Canada's long-standing energy relationship with the United States is undergoing a quiet yet powerful transformation. For decades, over 95% of Canadian crude oil exports flowed southward into the U.S., creating a deep but dangerously one-sided dependency. However, recent tariff threats from Washington, notably a proposed 10% levy on Canadian oil and gas, have acted as a catalyst for Ottawa to finally rethink its energy strategy. And the timing couldn't be more critical. Enter Rongsheng Petrochemical, a Chinese energy giant with ambitions as expansive as its refining capacity of 800,000 barrels per day. By setting up shop in Calgary and swiftly securing a supply deal with Suncor Energy, Rongsheng isn't just buying oil, it's embedding itself in the North American energy landscape. First shipments set sail in June 2024, marking not only a new revenue stream for Canada, but a geopolitical statement. Canada is no longer content being a single market supplier. From a broader international trade lens, this deal signals China's masterstroke in diversifying energy sources amid mounting tensions with the U.S. and European suppliers. But for Canada, it's more than just opportunistic diplomacy. It's a strategic liberation. Years of lobbying to expand pipeline infrastructure, most notably the Trans Mountain Expansion, TMX, are now bearing fruit. With direct access to Pacific markets, Canada can finally bypass the U.S. bottleneck. This moment feels like Canada's geopolitical coming of age in the energy sector. No longer just a reliable junior partner to the U.S., Canada is positioning itself as an independent player with global reach. And with China stepping up as an eager buyer, Canada gains leverage, not just in oil negotiations, but in reshaping its entire trade narrative. It's proof that in a shifting global order, even resource-rich nations must learn to diversify, or risk becoming collateral in someone else's tariff war. Trans Mountain Pipeline Expansion. The completion of the Trans Mountain Pipeline Expansion, TMX, in early 2024 represents more than just a leap in infrastructure. It is a strategic milestone in Canada's journey toward energy independence and global relevance. By tripling capacity from 300,000 to 890,000 barrels per day, the TMX has effectively broken the monopoly that U.S. pipelines held over Canadian oil exports for decades. For the first time in modern history, Canadian crude can flow westward directly to Pacific ports, bypassing the geopolitical bottleneck of American transit routes. From a trade perspective, the significance of TMX is profound. It grants Canada a physical pathway to diversify its customer base, particularly toward Asia, home to the fastest-growing energy markets in the world. Nations like China, Japan, South Korea, and India are hungry for reliable, stable energy supplies, especially given their own tensions with traditional Middle Eastern suppliers and the volatility in Russia's oil exports. Canada, with its political stability and transparent regulatory system, is suddenly a very attractive alternative. But here's where it gets interesting. TMX isn't just about moving oil, it's about moving power. The power to choose partners, the power to negotiate prices, the power to resist foreign economic pressure. For years, Canada's energy sector was treated as a junior player in the North American supply chain, overly reliant on U.S. demand and vulnerable to policy shocks like tariffs or presidential decrees. TMX changes that equation. TMX is a lesson in long-term vision and national resilience. It took years of political wrangling, environmental assessments, protests, and billions of dollars in investment to bring this project to life. But the payoff is enormous. Canada is no longer just shipping oil, it's shipping a new message to the world. We're open for business, and we're not putting all our barrels in one basket anymore. LNG Canada's progress. The LNG Canada project, nestled in the remote coastal town of Kitimat, British Columbia, is rapidly nearing its final stages. As of late 2024, construction was more than 95% complete, with the first exports expected to begin in mid-2025. While it may have attracted less global fanfare compared to mega projects in Qatar or the U.S. Gulf Coast, LNG Canada represents a seismic shift in the international energy map, especially for Asia. This $40 billion mega project, backed by a consortium that includes Shell, Petronas, Malaysia, Mitsubishi, Japan, PetroChina, and Korea Gas, isn't just another LNG terminal. It's a new energy gateway between North America and Asia. Once operational, it'll have the capacity to export roughly 14 million metric tons of LNG per year, with plans for future expansion. Crucially, it offers Asian economies a new, geopolitically stable supplier in an era when energy security is no longer just about price. It's about reliability, diplomacy, and long-term trust. The geographic positioning of Kitimat gives it a competitive edge. Shorter shipping distances across the Pacific compared to U.S. Gulf ports translate to lower transport costs and faster delivery, factors that are increasingly decisive in today's volatile energy markets. Moreover, Canada's regulatory environment, while stringent, provides greater transparency and environmental oversight, which is appealing to countries and companies under growing pressure to green their supply chains. LNG Canada symbolizes a rare blend of foresight and pragmatism. While global attention often focuses on political drama and tariff battles, Canada has quietly been building the physical and diplomatic infrastructure necessary to compete in the next phase of global energy trade. It's not just exporting gas, it's exporting reliability, rule of law, and long-term partnership. And in an age when energy has become the front line of geopolitics, that might be Canada's most valuable commodity. BRICS' currency initiatives. At first glance, the idea of BRICS launching its own currency, tentatively called the unit, might seem overly ambitious, even idealistic. But look deeper, and you'll find that this isn't just economic theory. It's a coordinated, deliberate move to shift the global financial center of gravity. During the 2024 BRICS summit in Kazan, Russia, leaders from Brazil, Russia, India, China, and South Africa, with observers from Egypt, UAE, and Ethiopia, among others, doubled down on plans to explore a unified settlement mechanism that could bypass the US dollar. Unlike past attempts by non-Western alliances to challenge the greenback, this initiative has teeth. The unit is being proposed not only as a digital currency, but one potentially backed by tangible assets, either a basket of member currencies, commodities, or even gold reserves. If implemented, it would be the first serious post-Bretton Woods attempt to create a parallel reserve system outside U.S. or IMF influence. From a trade perspective, this could be monumental. For years, the dollar's dominance has given the U.S. outsized power in global finance, from sanction regimes to controlling transaction flows through SWIFT. A BRICS-backed alternative could empower member nations and partners to conduct cross-border trade with reduced exposure to Western sanctions or financial disruptions. The BRICS currency effort isn't about immediate disruption, it's about slow-burn resilience. It mirrors a rising sentiment among emerging economies. We don't want to burn down the system. We just want a seat at the table, or maybe build our own. In a world increasingly divided along geopolitical and economic lines, the success of such an initiative would not only redefine global commerce but signal the beginning of a truly multipolar monetary era. And perhaps that's exactly what the post-COVID, post-dollarized world has been moving toward all along. U.S. tariff policies and economic repercussions. The United States' return to aggressive tariff policies under the 2025 administration has reignited a wave of trade tensions that reverberates far beyond bilateral disputes. In April 2025, President Trump enacted a sweeping 10% universal tariff on all imported goods, positioning it as a defensive measure to protect American industries and jobs. However, the policy included targeted escalations, 25% tariffs on imported automobiles and auto parts, and up to 54% cumulative tariffs on a broad range of Chinese imports. This sweeping protectionist approach triggered immediate and forceful retaliatory actions from global trading partners, particularly China. Beijing swiftly imposed a 34% blanket tariff on all U.S. goods and introduced new export controls on rare earth elements, lithium, and graphite, materials critical for U.S. electric vehicle production, electronics, and military technologies. These actions disrupted supply chains dependent on just-in-time deliveries and caused delays across major sectors such as clean energy, semiconductors, and advanced manufacturing. According to data from the World Trade Organization, WTO, global trade growth slowed from a projected 2.6% to just 1.4% in the first half of 2025, with uncertainty around tariffs cited as a primary contributing factor. Multinational firms began revising earnings forecasts and suspending investment decisions amid volatile currency markets and shifting demand patterns. In the U.S., the cost of consumer goods began to rise as businesses passed import costs onto buyers, prompting inflationary concerns even as interest rates remained high. International trade institutions such as the OECD and IMF issued joint warnings that continued tariff escalations could shave 1.5% off global GDP growth in 2025, 2026 if no policy shifts occur. Furthermore, alternative trading routes and alliances began to accelerate, with ASEAN countries, the EU, and China deepening intra-regional agreements to shield themselves from U.S. policy unpredictability. In this context, tariffs are no longer mere economic tools. They are reshaping the architecture of global trade itself. Market responses and economic indicators. Financial markets have demonstrated heightened sensitivity to the ongoing trade policy shifts, especially in the wake of the comprehensive tariff measures announced by the U.S. administration in April 2025. Major U.S. indices such as the S&P 500 and the Dow Jones Industrial Average recorded sharp declines in the days following both the U.S. tariff announcements and the retaliatory actions from China. The Nasdaq Composite also fell significantly, led by losses in the technology and industrial sectors, both heavily reliant on global supply chains. According to Bloomberg and Refinitiv data, investor sentiment dipped noticeably, with the VIX, often referred to as the Fear Index, spiking to its highest level since early 2022. Fund outflows from U.S. equities accelerated as institutional investors sought refuge in gold, bonds, and emerging markets not directly affected by the trade standoff. Simultaneously, the U.S. dollar weakened against a basket of major currencies, including the Chinese yuan and the euro, reflecting concerns about the long-term stability of U.S. trade relationships. Interestingly, not all sectors were negatively impacted. Homebuilding stocks, represented by the iShares U.S. Home Construction ETF, gained as investors anticipated a redirection of domestic capital toward infrastructure and housing. Retailers with a strong domestic manufacturing footprint also experienced moderate gains, as companies positioned to benefit from reshoring trends were viewed as potential winners in a more protectionist economy. On the macroeconomic side, early indicators from the U.S. Department of Commerce showed a 0.8% dip in consumer spending in Q2 2025, while business investment slowed by 1.2% year over year. Inflationary pressures resurfaced as import costs rose, prompting the Federal Reserve to maintain high interest rates despite slowing growth. Global investors, meanwhile, shifted part of their portfolio to Asia-Pacific markets, where trade agreements like RCEP, Regional Comprehensive Economic Partnership, continued to provide a buffer against volatility linked to U.S.-centric conflicts. Global energy market dynamics. The shifting dynamics of the global energy market have entered a new phase defined by strategic realignments and diversification efforts. China's pivot away from U.S. liquefied natural gas, LNG, toward Australian suppliers, and Canada's expanded outreach to Asian markets for crude oil exports exemplify a broader trend among nations to recalibrate their energy dependencies. These changes are not isolated. They are part of a global pattern in which countries are actively restructuring energy partnerships to avoid geopolitical and trade-related vulnerabilities. Following the introduction of U.S. tariffs and the subsequent retaliatory measures, energy importing nations have become increasingly wary of over-reliance on politically volatile partners. According to the International Energy Agency, IEA, in 2024 alone, over 30 new bilateral and multilateral energy agreements were signed across Asia, Africa, and the Middle East, many of which excluded Western partners. For instance, China and Qatar expanded their 27-year LNG agreement, while India signed long-term oil supply deals with Brazil and Russia to secure stable energy inflows amid global uncertainties. At the same time, exporting nations are investing heavily in infrastructure to enhance their reach. And Canada's Trans Mountain Expansion, TMX, and LNG Canada project, as well as Australia's continued investment in LNG terminals and shipping capabilities, signal a clear effort to tap into new and emerging markets. Meanwhile, African producers such as Mozambique and Nigeria are ramping up LNG capacity to capture a share of the shifting demand landscape, particularly in Asia. Additionally, the rise of regional trade frameworks such as the RCEP and the African Continental Free Trade Area, AFCFTA, is facilitating intra-regional energy trade, reducing the need to rely on long-haul exports tied to geopolitically tense corridors. These developments point to a future where energy flows are no longer dominated by a few major players, but instead spread across a web of dynamic, multipolar partnerships designed to enhance resilience in an increasingly fragmented global order. The current global economic environment is characterized by rapid shifts in trade alliances, energy partnerships, and financial strategies. China's cessation of U.S. LNG imports in favor of Australian supplies, Canada's proactive steps to diversify its oil export destinations, and the BRICS coalition's exploration of a new reserve currency all reflect a broader trend toward reducing reliance on traditional economic powers and fostering a more multipolar global economy. These developments highlight the intricate interdependencies that define international trade and the ongoing efforts of nations to navigate and influence this complex system.